GoPro reported disappointing results last night, and as a result, the share price is down to about $25 a share in pre-market trading, which represents a decrease of about 16.5% from the close yesterday. In this video, we're going to take a look at our model prior to the release and now our updated model that includes the new guidance that management gave us on the earnings call last night, and see if that price move makes sense. Now, before we get to the guidance for the fourth quarter, we should take a look at some of the results from the September quarter. On the right hand side of the screen is our new model with all of the updates. On the left hand side of the screen is the model from yesterday prior to the release, and you can see all these orange cells mean that the top line revenue and the bottom line EPS numbers were calibrated to meet consensus estimates ahead of the close. So now if we look to September and we scroll down to the segment details, we can see how the company did. So in our prior model, we were expecting quarter-over-quarter growth of 3.2%, which would have gotten us to that consensus revenue estimate. And the actual growth was a decline in units shipped of just over 3%. The revenue per unit held up pretty well, though. I guess they did sell a pretty good mix of cameras, so the revenue per unit was $251 versus $255 in our model. On the OpEx side, however, expenses were increasing and higher than what we were modeling. So in our model, we had 13.9 and 13.5 as a percentage of revenue for R&D and sales and marketing, respectively, and we ended up with 16.8 and 16.6%. So much higher than our expectations. However, gross margin was at the high end of management's range, so management guided to 46% plus or minus 50 basis points, and they got 46.6, so 10 basis points above the high end of that range. So that was a little bit of good news. On the non-GAAP adjustments, as we pointed out in our video yesterday, in order to get back to the street's EPS estimate and to the midpoint of management's range, we had to assume a lower stock-based comp relative to what we've seen the past couple of quarters. So we ended up putting about $8.3 million in stock-based comp in our model, and the final for the quarter ended up being 17.9. And we actually have a similar situation this quarter where, in order to get back to management's midpoint for the fourth quarter, we had to bring that stock-based comp way down. So that might be an item that you want to change. That's what we've highlighted in red here. Alright, so scrolling back up to the income statement, let's take a look at the guidance for the fourth quarter. So prior to the release, the street was looking for $690 million of revenue, and the guidance, the midpoint of guidance, is just $525 million. On the OpEx side, we are modeling about $165 million for total OpEx, and that's the midpoint of what management's guidance is. However, it's on a much lower revenue base. So if the revenue base was higher and they guided to 165, that would be a little bit more interesting. On the gross profit side, they guided gross margin to 46%, again, plus or minus 50 basis points, which is that item might be a little conservative because in the fourth quarter you would expect to see some gross margin expansion. What else did they guide? They guided the effective tax rate to 23% and the diluted share count to 147 million shares. So when we model all that out, we do get back to the midpoint of management's EPS guidance, but like we were saying before, we had to bring the stock-based compensation expense as a percentage of revenue way down. So you may want to increase this just a bit, but just keep in mind if you do that, the EPS is going to increase as well. And we know that the street was looking for 29 cents last quarter, and that was the low end of management's range, so they'll probably set their models again to the low end of management's range at 35 cents, so you probably don't want to increase this by too much. So now, having done all of that, if we look at the change in value implied by the model, yesterday we were at $31 a share, and now we're at about $25.50 a share. And keep in mind that at this point we haven't adjusted the future periods, so we're going to wait to see what the consensus results come in at for March and June of next year. But analysts probably will reduce those growth targets. As a result, this $25.50 a share is probably still a little bit too high. So overall, the price move does make sense based on the results from the third quarter and the guidance that management gave us for the fourth quarter. Thanks for watching, and be sure to check back after the consensus estimates come in when we update this model again.